So, you've got some disposable income and you're wondering, what should you do with it? Should you invest or should you overpay your mortgage? Now, this seems like a pretty complex problem to tackle because there are a bunch of variables at play and everybody seems to have a different point of view. You not only have to consider the maths, as in the most optimal financial play, you also have to consider the psychology or emotions that come into it, as well as the current economic conditions and the impact that they'll have. So today, we're going to go through every single aspect that you need to think about when it comes to deciding between investing or overpaying your mortgage, with some real world examples. And we'll also look at how today's current economic conditions are going to mix things up. Let's get straight into it. Buying our own home is one of the most fulfilling milestones that we will accomplish in our financial lives. The pride, comfort, and sense of achievement that comes along with it is unrivaled by most other purchases. But something else also makes this purchase one in a million. Debt. The average house price in the UK is around £270,000. And let me tell you for free, most people aren't going to be forking that out up front. If you were to cover the 10% deposit on that, you'd be taking out a mortgage of around £243,000. Combine that with the average fixed rate mortgage of around 2%, and with a 25-year mortgage, you'll be forking out £1,145 per month, whilst looking at a total repayment of 343 grand, with 73k of that being interest. But whilst these numbers may be painful to see, there may be hope. What if you have some disposable income so that you can pay down the mortgage early, reducing the interest payments and cutting down the length of your mortgage? The quicker you're paid off, the quicker you become financially free. But whilst all of this may seem appealing, you can't forget about the other choice that you have, which is to invest that money. Instead of trying to decrease your debt to zero, you can instead try and outrun that debt by growing your investment funds at a faster rate. So ultimately, it comes down to whether or not you want to pay down the debt on your home, which is going to save you money in interest, or if you want to allocate that money to invest towards the future. We're first going to dive into the numbers side of things to figure out which makes the most sense on paper. But don't forget that other psychological and economic factors can come into play, so we'll cover those after. Because this isn't a straightforward topic with several factors at play, the correct answer for you is absolutely going to depend on your individual circumstances. That's why I'm going to disclaim that I am not a financial advisor, and if you do want independent advice tailored to your own circumstances, then you should seek that from a professional. I'm simply going to be presenting my view on things, backed up with some numbers, so that you know all of the aspects that you need to be considering when making this decision for yourself. Let's get into the numbers. Before we dive into a real world example, I want to make it clear that when you're paying down your mortgage, you're saving money on the interest part of the loan. The higher the percentage APR on any loan, the more money that you're going to save by paying off that loan early, as it's going to stop the loan interest from compounding more and more each month or year. So if you do have any other high APR loans, such as credit card debt, which can have an APR as high as 20 or 40%, then I'd recommend that you pay those down first, because that's where you're going to make the most savings. But let's assume that you've done that already, and the only debt that you have is your mortgage debt. We'll use some similar numbers to the average values that we saw before. So let's say that you've got a £240,000 mortgage that's got a 25-year term and the interest rate is 3%. This 3% value is even higher than the 2% average that we saw earlier, which means that you should save even more money by paying it off early. With this mortgage, you're going to be making monthly payments of £1,138 per month. But let's say that you have an extra £200 per month that you can use to pay it down faster. If you were to make this payment every single month, you'd save a total of £22,592, and you'd have cleared off your debt 5 years and 1 month early. But of course, you'd also have the option to invest that money instead. For the sake of this example, let's assume that you earn a fairly conservative 5% per year on your investments. So by investing £200 per month over the same time period, which is 19 years and 11 months, you'd end up with a total of £91,749.43, which far outweighs the amount you save from paying down the mortgage instead. But of course, this is not a fair fight. In the example where we paid down our mortgage, we'd now be debt-free, which would mean that we'd have more money to allocate towards investing. But in the investing example, we still have 5 years and 1 month left on our mortgage, which means that we'd have less money to invest over that remaining time period. So let's run the numbers again. But this time, when we pay down our mortgage faster, let's also invest for that remaining time period. In the overpaying mortgage example, over that remaining 5 years and 1 month, you can now invest £1,338 per month, which is your old mortgage cost plus the £200 per month. If you earn 5% per year, you'll end up with £92,709.27. But back to the investing side of things. And of course, we're now investing £200 per month over the full 25-year time period. If we earn 5% per year, we end up with £119,101.94. You can see that the final amounts are much closer this time, with the investing example only beating the overpaying example by around £27,000 over the full 25 years. Ultimately, this victory for investing can be explained by a fairly simple concept. If the annual returns that you earn from investing are greater than the percentage APR on your mortgage loan, then you're going to be financially better off by focusing on investing instead of overpaying your mortgage. You can think of it as a sort of tug of war. On one side you have the mortgage debt, which is pulling in one direction, and in our example that was at 3%. But if the other side, which is investing, is pulling even harder with a strength of anything above 3%, then the investing side will win. But of course I said if. And that is a pretty big if, because we have to remember the nature of investing. The returns that you could earn from investing are not guaranteed. There is a chance that over the 20 to 25 year time period, the average yearly returns are less than 3% per year. For all we know, they could be negative. We just can't tell what's going to happen in the future. But when you choose to pay down your mortgage, you are guaranteed to make a saving that is equal to the percentage APR on your mortgage loan. And you should not underestimate the value of that guarantee. If there was an investment option that would definitely earn 2 or 3% per year, no matter what, most investors would be all over that. And that's exactly what you get when you pay down your mortgage early. You could also argue that you're protecting yourself from paying potentially higher interest rates in the future, but we'll get to that properly in a moment. Because before we start to look at how a high interest environment, which we are in now, will affect this decision, we first need to take a look at the psychological side of the argument. The feeling of actually owning your own home is one that should not be underestimated. The banks no longer have any stake in your property, you own everything. And at the end of the day, nobody can quantify how valuable that feeling is. It's going to vary from person to person, and it doesn't even really make sense to try and give it a monetary value. So even if the numbers suggest that, on paper, investing probably is the best financial decision, you still have to consider this side of the argument. You also can't forget that paying down a mortgage will free up much more cash flow for you to enjoy, which can be a huge relief for many people. Knowing that you will never again have to pay off this big monthly chunk, a payment that you've probably been making for at least a decade, will likely relieve you of a lot of stress. And again, you can't put a value on that. You have to consider why you were saving money and investing in the first place. And for many people, this ties in with financial security and happiness. Knowing that you will be done with your mortgage payment sooner will likely make you happy, even if it isn't the most numerically optimal way to invest your money. Another thing that we haven't considered is the accessibility of your money, depending on which option you choose. If you do choose to pay down your mortgage early, you will not be able to easily access that money in an emergency. Whereas if that money was invested, you could always sell out of an investment, even though it's not ideal, to access any funds. This really reinforces the importance of building an emergency fund before you choose to invest or pay down your mortgage. So please don't forget this side of the argument when you're looking up information on this topic, because nobody, including me, can tell you what you should do or what is going to make you happy. This is ultimately down to you. But before we do round up this topic, we have to address the elephant in the room. Inflation. As of November 2021, UK inflation was at 4.6%, and it is expected to exceed 5% over the next few months. To get this under control, the Bank of England have already raised the base interest rate to 0.25%, but it could rise even further in an attempt to reduce inflation. Higher interest rates mean a higher cost of borrowing, and the cost of mortgages will increase across the country. So whilst the average mortgage rate is low now, at around 2%, there is a risk that these mortgage rates could rise in the future to maybe 3, 4, or even 5%. This is going to increase the amount of money that you save when you pay down your mortgage early, and it will make investing less attractive. So let's take a look at some forecasts to plan what the best strategy may be for the future. I don't think so. Nobody knows what is going to happen in the future. End of. Yes, forecasts and predictions exist, but the clue is in the name. They are just forecasts and predictions. Nothing is certain, and it probably won't play out as people expect. Wasting your time searching through these reports is going to cause you more stress and worry than what it is worth. So instead of trying to predict the future, simply focus on what you know now. As things stand, from a numerical perspective, mortgage rates are lower than the long-term expected returns of a stock market. So for now, investing is more optimal, on paper. If mortgage rates do start to rise, then the numbers could start to tilt towards overpaying your mortgage. But until that happens, there is no point in trying to worry or prepare for that. The decision that you make today should be based on today's economic conditions, not some future conditions that may never even come to fruition. It's that simple. If you are on the fence with this decision still and can't make up your mind, it could make sense to run through your own numbers yourself. So I'd recommend using a mortgage overpayment calculator, which I'll make sure to link below. It's also worth stress setting your results with a few different values for the investing returns. If you plug in a value of say 4%, is it still in the favour of investing, or will it make you change your mind? Choosing the right route for you is a personal decision, so you shouldn't let anybody tell you the right thing to do. Unless they're a financial advisor who understands your financial situation completely, but even then, they'll likely lay out your options and you'll have to make the decision yourself. Some people will value the feeling of being debt-free as soon as possible and completely owning the bricks and mortar which they live in, whilst others will want to try and maximise every single penny whilst optimising their financial lives. Just remember to consider the complexities of each side of the argument, such as the risks that come with investing or the accessibility of your money if you choose to pay down your mortgage instead, so that you can make the most informed decision possible. But either way, the fact that you're choosing between either of these options means that you're probably smashing it, so hats off to you.
Yeah, well done, mate.
If you are leaning towards the investing side of things, I think you'll like this video here, where we discuss Vanguard's best ETFs for 2022. You won't want to miss it. Now, thanks for watching everybody, and I'll see you in the next one. Cheers.